If your trading strategy has a lot of parameters or rules, it can easily overfit to the historical data. An overfit strategy models the past so closely that it's able to produce a nice backtest result, but it's usually not robust enough to perform well on new live data. One of the best ways to test if your algorithm is overfit is to test the algorithm on data that wasn't available when you originally developed the strategy. Kevin Davey often talks about keeping strategies in an incubation period before live trading. The incubation period is just a period of time after you've developed the strategy where you don't trade the strategy with real money, but you see how it performs on new live data. If the strategy continues to perform well on the new live data, it can give you greater confidence that the strategy wasn't overfit and is robust enough to perform well in live trading. In September 2022, I published this consumer price index strategy to the QuantConnect forum. The strategy outperformed the S&P 500 index in terms of risk-adjusted returns, and the strategy ended on September 14th, 2022. So there's been about 2.5 months of new live data that's been generated since I published this strategy. The strategy has also been cloned 133 times, so today I'd like to revisit this strategy and see how the strategy would have performed if you started live trading it on the day that I published this to the QuantConnect forum. Since I shared this strategy, there's been 2 new CPI rate announcements. To collect the new data, I downloaded the official CPI rates from the US Bureau of Labor Statistics website. This chart now includes the report for September and October 2022. I was able to get their CPI rate from this chart, and I was able to get the release date from the archive news releases. For example, the September report was released on October 13th at 8:30 a.m. Eastern Time. I uploaded the new data into Dropbox so I could import it into the algorithm, and here's what the CPI rate looks like in a time series. To clarify how the strategy works, every time a new CPI rate is released, we compare it to the previous CPI rate. If the CPI is increasing, we identify the current market regime to be in a state of rising inflation. This image shows periods of time when the CPI rate was increasing. They are identified with the green zones, and the red zones identify areas where the inflation rate was not increasing. The universe consists of all 500 stocks in the S&P 500 index. Anytime the CPI rate is released or the universe changes, we rebalance the portfolio. During each rebalance, we look at the trailing year of data to determine which equities to invest in. This image shows the CPI rate over the last year and the zones of increasing inflation. Note that in this image, there's a red zone between May 11th and June 10th, even though the line that represents the CPI data is increasing during this time. This period of time is red because the CPI rate on May 11th is lower than the CPI rate on April 4th. And as a result, before the next CPI release on June 10th, these 2 trailing CPI rates show that we're in a state of falling inflation. Also note that the most recent zone is red. Since the most recent CPI value is lower than the previous CPI value, we're no longer in a state of rising inflation. If we rebalance today, we take the trailing 1 year of price data for each asset in the universe. Take, for example, the trailing prices of XOM. If we apply the same zone highlighting, we can see how XOM performed during periods of rising inflation and periods of time when the inflation was not rising. During each rebalance, we take the subset of history that matches the current market state. In this example, the current market state is red, so we only take the closing prices of the red zones. With this subset of data, we can calculate the annualized Sharpe ratio of the security during times that match the current market environment. We do this for all 500 stocks in the universe, and we rank all the stocks by their annualized Sharpe ratio given the market state, and we select the top 25% of stocks. We then form a market cap weighted portfolio of the stocks, and we hold them until the next rebalance. The out-of-sample period consists of data from September 13th to November 23rd. During that time, the SPY benchmark achieved a 0.43 return, and a Sharpe ratio of 0.569. In contrast, the strategy achieved a 7.34 return and a Sharpe ratio of 1.393. Therefore, the strategy continues to outperform the underlying ETF during the true out-of-sample period. This pie chart shows the current holdings of the strategy portfolio as of November 26, 2022. I show the tickers of the 20 largest positions. To get the entire list of the portfolio, see the research notebook in the attached project. The portfolio weights will likely adjust when the universe changes or the new CPI data point is released. The Bureau of Labor Statistics website says that we can expect the next CPI release to be on December 13th at 8:30 a.m. I've attached the strategy code below. Take a look at it, clone it, and run it if you want to. Let me know what you think.